So far we have been trying to set things up to start the analysis of macroeconomics. And a couple of basics that we have looked at initially is, first of all, this thing known as macroeconomic indicators, where we learned how in macroeconomics we think about aggregate variables such as total output and total employment and so on and so forth. And then we also looked at the way in which we simplify things in macroeconomics by assuming that there are just four actors or four players, or what we said, four main sectors that do all the action. Now what we are going to do now in this video is to learn how we can think about the way in which these four sectors interact with each other, how we can think about that in a hypothetical way through something known as the circular flow of the macroeconomy. And by the end of this video, through this understanding of the circular flow, we will try to learn the meaning of this thing known as the national income identity, or sometimes national income accounting, as well as something known as the leakages equal to injections. You can say condition or model or whatever you may call it, but leakages equal to injections. That is something we will learn by the end of this video. Now let me just start off by setting up a very simple circular flow, as simple as it gets, because we are going to begin by assuming that instead of all of these four sectors, we have a simple two-sector economy where we just have households and firms. Now the way, or the link through which these sectors interact with each other, are two markets that exist in a country's macroeconomy. Now one of them is the goods and services market. This is again an imaginary market where we assume all of the country's different products, all of the country's total output is brought, and this is where it is sold and bought. And on the other hand, we have this second market, the factor market. Now what do we mean by factor? Here are the four factors of production: land, labor, capital, and enterprise. And we assume that for any production to take place, firms will have to buy these resources: land, labor, capital, and enterprise. And all of these resources in turn, we assume they are owned by these households. Out of all of these four sectors, we assume only households, they own all of these resources, and these households bring these resources to this factor market to sell them, and from here the firms buy these resources. And that actually gives you the first semicircle, or the lower half of your circular flow. Resources owned by the households. They move in a clockwise direction through the factor markets to the firms. Now, obviously, the firms, they are buying these resources because they want to make goods and services. So once they have made these goods and services, they bring them to these goods and services markets, where most of the total output of the country is bought by the households. And remember, we said whenever households buy part of country's total output, that is known as consumption. So most of the country's total output is consumed. And hence the name circular flow. Resources, they move from the households to the firms, and from there they continue to move clockwise to the goods market, and through them in the same clockwise direction to these households. The circular flow of resources and goods between households and firms. Now, this circular flow, you can say this neat little circle is disturbed, but in a very useful way, because you have to remember from the very beginning that in the simple two-sector economy, I'm again and again saying that most of the country's total output is bought by the household. Most of it is consumed. But do remember that these firms, they have a dual role in the circular flow, in the sense, so in the sense they have dual role, let's bring them here as well. The second role of the firms, in addition to producing the country's total output, is that these firms will sometimes also buy some of the country's output. So think of yourself as somebody trying to set up a new firm. You will have to buy the furniture, you will have to buy the stationery, you will have to basically set things up. And for that, as a firm, you will have to buy some of the country's total output. And all of this output bought by the firms, remember, we said, is given the name of investment. Now, we also sometimes call these investments, this output of the country going to the firms, as injection. Injection meaning that this inner circle is the main circular flow where households are selling their resources and they are then getting goods in return flowing back to them. So most of the country's demand for output is coming from these households, but in addition to the demand coming from the households, there is some injection, we say, of additional demand in the shape of investments coming from the firms. So this is an important term for you to understand from the very beginning. Injections meaning additional demand in addition on top of the main source, the demand for the country's output coming from the households. Now, the next step to continue building our analysis involves a consideration of the flow of money that will take place in this simple hypothetical macroeconomy. That is, when these households, they sell their resources to the firms, they do that in the hope of, or in the expectation of earning a reward, earning an income. So whereas resources flow from the households to firm, money, we say the nominal flow, it will be in the opposite anti-clockwise direction from the firms to the households. And similarly, these households and these firms, which are buying the country's total output, when households consume and buy things from these goods market, they obviously have to pay money in return. So nominal money flow will be in again the opposite direction, the anti-clockwise direction. Similarly, these firms, goods flow from the goods market to these firms, but in return these firms will have to pay money. So nominal flow is again in the opposite direction. Now, we'll complete this nominal flow, but as I go through that, let me introduce some more important terminology. First of all, you have to remember that since in this simple circular flow, we are assuming that we have just these two sectors, the households and the firms, therefore, we say that the sum of consumption and investment, the sum of demand coming from both the sectors of the economy, the sum of demand for the country's total output, C and I, we say is the country's total aggregate demand or the country's total aggregate expenditure, depending on whether you are thinking in terms of the real flow of goods or the nominal flows of money. So when you are thinking in terms of these nominal flows that we are doing just now, we would say the total expenditure on the country's total output is C plus I, the sum of expenditures coming from households and the firms. Now the next question that will give us the next term that we want to understand is that how much will the C plus I be? How much will this total spending on the country's output, what will that amount be? Now in equilibrium, when there is no shortage or no surplus and whatever the firms have produced is being bought, then it is simple to see that, look, the total sum of C and I, the total spending on the country's output, that will be equal to what we say, and this is an important term, the market value of that total output. Now, market value, let me just quickly explain what that means. You see, if your country, and this is a very small box, let me make a bigger one. See, if your country is, let's say, making 50 chairs, and the price of every chair is, let's say, 10 rupees. Then this is where we say that the market value of these 50 chairs, of this real quantity, the amount, the market value would be 50 into 10, the quantity times price of 500 rupees. This would be the market value of these chairs. And then you would look at, let's say this country is also producing 10 tables and the price of every table is, let's say, 100 rupees. Then you would again calculate the market value of these 10 tables by multiplying its quantity by the price, and you would get 1000 rupees as the market value. So you would look at all the different products that the country produces, you will multiply their quantities by their prices, and you will get market values of all the different products. You would then add them up to get the total market value of output. That is what we mean when we say the market value of the country's total output. Now we will come back to this calculation. We will look at the details, but here the idea that we want is that if, let's assume, the total market value of this country's output, whose circular flow that we are considering is, let's assume an imaginary number, 20 rupees to keep things simple. Then we are saying that this total spending will also be 20 rupees. And then these 20 rupees would come to these firms. Now, what would these firms do with these 20 rupees? Well, we assume that they would either keep them as profits, or they would use that money to pay off for the land, labor, capital that they hired. Now, profit is the reward to these entrepreneurs, and these land, labor and capital, land would get rent and labor would get wage and capital would get interest. These are the rewards to these four factors of production. So this 20 rupees of spending on 20 rupees of market value of country's output will be received by the firms, and then these 20 rupees will flow back through these factor markets in the form of these payments or rewards to these factors of production back to these households. We assume that all of the country's resources are owned by the households. So all of these income, whether they are rents or wages or interests or even profits, the resource of entrepreneur also we assumed is owned by the household. So all of these incomes flow back, we say, to the household. So this gives us a nominal analysis of the money flows between these two sectors of this hypothetical macroeconomy. Now, all of this allows us to get to our first major insight that we need to get out of the circular flow. And that insight is that in this macroeconomy, when it is in an equilibrium, a macroequilibrium simply meaning that the total amount of output that these firms have decided to produce is exactly the same as the total amount of output that these two sectors want to buy, then in this macroequilibrium, this analysis of nominal money flows is telling us that the total spending, the C plus I, that will be first of all equal to the value of that country's output, and in turn it will also be equal to the total national income. Because this 20 rupees of spending, as we just explained, flows back to these firms, and then these firms either keep it as profit or give away wages or rents or interest to the factors of production that have been used to make all of this output. So the basic insight then becomes that, look, it's the country's total output that really matters. Because it's the value of that output that will be spent, and it is exactly that value, that spending, that will then become income of somebody in that particular macroeconomy. So the more you produce as a country, the larger will be the market value of output, the larger will be the total spending, and therefore the larger will be the total national income, the sum of wages and rents and interest and profits. And this is known as your national income identity, the fact that in macroeconomic equilibrium, the market value of total output and the total national spending and the total national income, they will be the same. And this is also the reason why you see so much focus, so much stress on the need to somehow increase the country's GDP, because GDP is nothing more than a fancy term that defines this market value of country's total output. So the more the GDP is, the more the total output is, the larger will be the total value of output, and the larger, we say, simply will be the size of the country's macro circular flow. So if you are producing 20 billion rupees worth of goods, then 20 billion rupees worth of spending will take place and 20 billion rupees worth of incomes will be generated. Now, obviously, the macroeconomy, it will settle into a certain equilibrium, such as in this case of our innocent hypothetical economy, we are saying it's just producing 20 rupees worth of goods, so 20 is being spent and 20 is becoming income. Now, the equilibrium will stay at this level, that is, and I want to make sure that you get it, in equilibrium, whether it is at 20 million or 20 billion or 20 trillion rupees, the national income will be equal to market value of output, and that will be equal to the total national spending. That will always be true. But you also need to understand that for a country to stay at a certain equilibrium, in this case at 20 rupees of output value and spending and income, the condition that needs to be met is that the leakages from the circular flow should be equal to injections. As long as that is true, the economy will stay at this equilibrium of 20 rupees worth of value of output and spending and income, as long as the leakages from the circular flow are equal to the injections into the circular flow. Now, we have already touched upon what injections are. Remember, earlier in this video I explained that most of the demand for countries' total output comes from these households. So most of the expenditure therefore on the country's output is the consumption expenditure being done by the consumers, or I should say the households. But I explained that sometimes firms, they also buy some of the country's output, and therefore we say the firms also inject some spending on the country's total output or in this circular flow of the macroeconomy. So firms, we are saying, contribute towards creating or injecting money and spending and demand for the country's total output. And that is your injection. Now, to understand what is a leakage, let us start a circular flow, again assuming 20 rupees is the size of that circular flow. So that would mean that in a given period, together household and firms, they would spend the C plus I of a total amount of 20 rupees on this 20 rupees worth of goods, and they would then flow back to these households in the form of income. Now, although usually households, they spend most of the income that they earn in any given period of time, but you do have to remember that households always save some. So if after receiving these 20 rupees of incomes, households, let's say, decide to save 3 rupees, then those savings of 3 rupees are considered to be a leakage from the circular flow of spendings and incomes. That is, households and the firms, they spent 20 rupees together on 20 rupees worth of goods. Therefore, households eventually received back 20 rupees of income. But we are saying instead of all of this 20 rupees going and flowing again back and staying within this flow, some of it leaks out. 3 rupees leaks out in the form of savings. Now, where would these leakages, where would these savings go? Would they just disappear from the macroeconomy? Of course they won't. These savings, it's basically the source of money for these firms when they decide to invest and buy the country's output. Because you see, we are assuming that it's the households who own all of these 4 resources. So all the incomes that are generated, whether they are rents or wages or interest or even profit, that will flow back to these households. Because even the resource of entrepreneur, that is, we assume, owned by the households. So firms, when they have to inject spending into the circular flow, they don't have any incomes. So where do they get this money from? Well, you see, the link is that these savings, they are put or saved with financial institutions such as banks. And to these banks come these firms when they need money to invest and set up new things or buy capital or whatever the requirement is. So these leakages in the shape of savings, they end up in banks. Here the firms come and take this money away from the banks and then inject these savings back into the circular flow. And this is where it becomes very easy to see that, look, if 20 rupees was spent together by households and firms on 20 rupees worth of output, and therefore 20 rupees of incomes reach these households. Now, if 3 is leaking, then households will be left with 17. They will be assumed spend all of that, consume all of that. So if 3 has leaked out of the system, then if through these firms, via these banks and financial institutions, if 3 of that same saving that leaked out comes back, it gets injected back in the form of investment, then the size of the circular flow will again stay the same. 20 rupees of income, 3 leaks out, so 17 was consumed. Now that leakage via that financial institution through the firms in the form of investment injection, those 3 rupees come back into the system, and the circular flow therefore would be maintained at 20 rupees. So that gives you this condition that for the macroeconomy to be in a certain equilibrium, the savings must be equal to investment. The leakages from the circular flow must be equal to injections into that circular flow. And since we are just considering a two-sector economy, the only leakage is saving and the only injection is investment. But the principle that we have learned is as true for a four-sector economy as it is for a two-sector economy. Now we can very easily add the other two sectors to these two equations that we have to complete the analysis, to complete our national income identity as well as this leakages and withdrawal equation. Now the only thing that needs to be added when we bring in the two sectors, the government and the external sector, is that you see both of these sectors, they will each create one extra injection into the circular flow and one extra leakage. So as far as government is concerned, government also buys some of the country's output, and whatever the government spends on the country's total output, that is known as G, and we considered it as an other injection in addition to the investment coming from the firms. Whereas as far as leakages are concerned, when the government is included in the circular flow, then remember the government will every year put a certain amount of tax on the amount of incomes that people are earning. So the amount of tax that households have to pay out of their incomes is another source, we say, of a leakage from the circular flow. And similarly, if you consider the external sector, when you consider your dealings with other countries, then sometimes foreign countries will come and start buying your country's products, your country's exports. So all of the exports of a country are considered to be injections of demand, injections of spending by foreigners into your country's circular flow. Whereas on the other hand, when you consider this external sector, you also have to decide that every year or every period of time as households earn a certain amount of income, and then also remember that some of the household's income will be spent not on the products of their own country. Instead, they would spend some of their income on imports. So imports, whatever the country every year spends on imports, is also considered to be a leakage from this circular flow of that macroeconomy. Now, since you already have the basic concept of the circular flow, what is the total spending and what is this, the leakages and injections, the only thing that changes in these two equations after adding these two other sections or sectors of the macroeconomy is that this national income identity, it will still tell you the same thing, that the market value of output will be equal to the total spending and that will be equal to the total national income. But with four sectors, always remember that the total aggregate expenditure on that economy's domestic market, domestic output, is the sum of the demand coming from the four sectors, the C plus I and now G and E as well. So C plus I plus G plus E is the total aggregate expenditure in a four-sector economy. Now, it is not exactly E, to be more precise, it's always NE, net exports. So C plus I plus G plus net exports. But I will explain in another separate video. It's a minor point that why do we consider net exports and what is the meaning of net exports. But here, the basic idea is the total spending with four sectors is the spending of all of these four sectors. And this national income identity is still telling you the same thing, that C plus I plus G plus NX, the total spending, will be equal to the country's market value of total output, and that in turn will be equal to the total national income, which will still be W plus R plus I plus profits. That doesn't change with the addition of these two sectors. And as far as this leakages injections equation is concerned, previously we just had one leakage of saving and one injection of investment. Now we have two other leakages and two other injections. So this equation still basically conceptually is the same, that the macroeconomic circular flow will be in equilibrium when the total leakages are equal to the total injections, or this time savings plus imports plus tax spending. When that is equal to the injections of investment plus government spending plus exports, then we say the circular flow will stabilize at a certain level of equilibrium. So that completes our analysis of what is the circular flow and how we can think about the nominal money flows to understand this national income identity, which is giving us the idea that the total spending that will depend on the country's value of total output, and that in turn will also be equal to the total national income that will be generated in that country. This equation over here is just a condition for the equilibrium to be maintained at a certain level. Now we can talk about how equilibrium will change when leakages are not equal to injections. This is something that we will look at in detail in A2. But for now, in the remainder of this first section, we are now going to talk about the three different methods through which a country can measure its GDP. Now, when we analyze and look at the three different ways in which you can measure a country's GDP, then this whole analysis is also sometimes known as the country's national income accounting. Now, the reason why you have three different ways of measuring a country's GDP and why that analysis is known as national income accounting, that is reflected in this national income identity. Because this thing over here, this whole analysis that we have done in this video, what it tells us is that, look, the market value of your country's output, your GDP, it will be equal to the country's total spending, and it will also be equal to the country's total national income. So you can, instead of, taking the direct route where you add up the market value of each individual product, when you do that, that is known as the output approach towards measuring GDP. Instead of doing that, you can take the expenditure approach where you add up all of these expenditures coming from the economy's four sectors, the sum of C plus I plus D plus NX. Or you can take the income approach. You can add up all the incomes, all the wages and rents and interest and profit that is generated in the economy. The government has tax records. So you can add up all the incomes, and again you can use this income approach to measure the country's GDP. And since all of these three things, this identity tells us, are always equal, they are the same, therefore when we talk about the methods in which you can measure a country's GDP, while you measure a country's GDP, you will automatically end up measuring that country's national income as well. So that's the background to what we are going to do now. And first of all, we are going to look at this output approach in a bit more detail in the next video. And as we go through that, we will learn about the difference between real and nominal GDP. And after that, in the next video, we will look at this expenditure and income approach together in one same video. And that would cover you for the MCQs that you get in the paper 1 of your AS part of your A level on these basics of national income accounting and the ways in which you can measure a country's GDP. And then we'll finally move on to the section 2, where we start the real thing, a build-up of the model of aggregate demand and aggregate supply.